Very nice to have you again here, Eduardo. Looking forward for another great webinar.
Thank you, Alex. Thank you. Good evening, everybody. Welcome to this new webinar. Uh, Tonight we will be starting the new month of November after a small relax break last week. We are getting started talking about a different branch of the order flow analysis, which will be starting from today on, and we will be talking about this part still relating to the order flow analysis, but let's say we are getting into the most advanced part of the order flow analysis, which is how to read a liquidity heat map. We will be going on for with this macro topic for the next 4 webinars, and basically compared to what we have been talking about until last week, until last webinar we had, the most important news, let's put it this way, is that we will be adding a new element and a new character in our analysis. We were talking about footprint chart last time. I'm gonna just a second. I'm gonna share my screen for you. Here it is. You should be able to see it. So until last webinar, we have been talking about footprint chart, which basically was as we said, the most important and the most advanced order flow tool, focusing on basically what aggressive, therefore, market orders are. Today, the new character we will have in our analysis will be a different kind of order, basically passive orders. You remember for sure what we said about in terms of difference between aggressive orders and passive order when we introduced for the first time the order flow topic, and we have talked about the market microstructure. Well, the question you might have been asking yourself is regarding footprint analysis, regarding the all of the delta tools we have been talking about over the last 4 weeks. If we are conducting an analysis of order basing on market orders, what about passive orders? I mean, am I missing something according to this analysis? Well, not completely, but there is still something important to be considered. I'll tell you first why we are not completely missing something. Even if looking at a footprint chart, we don't have, we don't really have an idea of where liquidity is, liquidity intended as passive orders. That means orders populating the order book, the so-called DOM, the DOM, depth of market. I actually can have an assumption of in which areas passive orders were providing more liquidity. By what? By the number of interaction being executed and showing as aggressive orders. That makes completely sense if you think about that, because I can only have or if I can spot with certainty, okay, lots of numbers of contracts being executed at market, which is what the footprint shows us, there had to be a counterpart here. There had to be the same number of passive orders providing liquidity to those aggressive traders taking this liquidity. That's the interaction. So even if we just look at a footprint chart or a delta bar or whatever to the cumulative delta, the CVD, the cumulative daily delta, showing levels where we had absorption, exhaustion, all of the order flow events we have been talking about, they give anyway an idea of where liquidity was provided. Of course, some of those tools are more accurate. Some of those tools are not that accurate. For example, if we compare a CVD with a footprint chart is way more accurate because we can have an idea, we can make more clearly an assumption of where liquidity was provided. Let's look at this nice swing to the upside. So we can also have the chance to recap a little bit what we said last time. We have a nice pressure to the upside here. Can you see price is accelerating in this bar to the upside with not that much of a volume. It finds some volume here. There is a surge of volume and of delta as well. Can you see nice chunky histograms and as well dark shaded delta? And lots of volume traded, of course, but then price may seek to overcome this area, still going up with no volume, not that much of a volume, until then again, same thing, volume increases, delta as well, price slows down a little bit here, then continues, and so on. So if we just concentrate our analysis on those areas of where volume gets heavier and delta as well, we can assume that on those price levels, we actually had more liquidity being provided. Otherwise, it would be impossible to have such a number of executions at market. Cool. The only downside is, in order to look at market this way and at price level in this way, we need to have those levels traded already, or at least in the near past. We aren't really able to know in advance where the most liquidity is provided until we don't get to trade it actually. And that's what Heatmap is for. Heatmap comes with a different software. So far, we have been looking at VolSys, the main volumetric trading platform. This is, which is let's say, the platform showing ordinary charts with all of the tools, like we said. Heatmap is another software still developed by Volumetrica Trading, which actually comes only with this kind of chart, which basically the first thing you can figure out by just looking at it is that we don't really have normal charts with candles, with price bars. We only have this line, okay, showing price changes and how the price has developed throughout the day, throughout the session. Of course, on the horizontal axis, we still have time, so we can just look at this line and its evolutions to just see where actually the price action, okay? And this line is accompanied by volume bubbles, which we will be talking shortly about. But the main feature about a heat map chart is that it comes with those colored bands in different areas of the chart. What do these bands represent? Well, basically, Heatmap is specifically thought to give a visual representation of the order book. We must have used here. This is what an order book, also called DOM, looks like. We have all of the price levels being in the with the ladder representation. So basically we have all of the price levels being stacked vertically. And of course, we have, well, this is an advanced order book, so it comes with many columns, but the main two columns are the ask column, the one here at the right, showing all of the passive orders waiting to be filled. So if those are passive orders, they are above the current traded price, those are sell limit orders. And you can see here actually how many orders are stacked on every single level above price. Those are sellers, passive sellers. Below the traded price, we have, oh, sorry, not this one. This one, the blue column, shows the bid side of the book, which basically contains tick by tick, level by level, all of the passive buyers. So all of the sellers, by passive buyers willing to buy at cheaper prices compared to the price area we are currently trading, which is represented by this yellow line. Okay, so that's the ordinary representation of DOM. Heatmap shows exactly the very same thing, but in a visual, with a visual representation. That means we still have the DOM over here. That's the bid. That's the ask. The yellow line is the currently traded price. Well, let's just focus on this histogram right here, okay? And as you can see, that's an outstanding number of orders compared to the average of the other price levels being close to that. Right? That means that here there are many sellers, passive sellers, willing to apparently sell with their pending orders. In fact, exactly here, we have a thick band, red, orange, showing exactly that compared to close levels above and below price, here there are many sellers, passive sellers, being in the book, okay, waiting to be filled, waiting to have their passive orders filled. Well, of course, that's a very easy example to understand. And you might say, well, it doesn't add too much because I can clearly see here there is an outstanding number of orders being here compared to above and below, right? But what, for example, about these? Here we have another band coming with slightly lighter colors than the one here. If we concentrate on the number, on the amount of selling orders being here, then yeah, we can tell why there is this band. 240, 39 compared to 138, 146, 110. Yeah, right. But you will definitely agree here is not that obvious as it is here. 90% of situations where we have a strong pool of passive orders tends to look more like this one rather than this one. So unless you are very familiar in reading the order book and analyzing numbers, raw numbers, as we are doing right now, it's not that easy to decipher what the evolution and the way passive traders are actually interacting. It can be a little bit difficult. Heatmap just give you an idea, a visual idea of what's happening, even when situations where there are more than the average passive sellers or buyers, it's just easier to spot, okay, even before those levels get traded. Because, for example, you can clearly see that now we have some liquidity pools a few points away from where we are right now. So we haven't been trading yet this area, but we know that if by any chance market wants to continue to the upside, it will find those two blocks of liquidity. And compared to what we said in terms of liquidities for the role of liquidity in order flow analysis, liquidity definitely at first, let's say, it is definitely a point of possible supports or resistance. Okay, why? Because of course, in order for market to go past this area, that means that somewhere here we will need more aggressive orders than the passive ones. So we need more conviction by aggressive traders. So that's a potential resistance in this case. Why resistance? Because liquidity is above the current price. So despite the color, regardless of the colors of these pools, I'm shortly talking about that and how to read the different color coding. Those are selling orders. Why? Not because of the colors, just because I can see clearly from here that this liquidity is above the currently traded price. So if we know that Heatmap is showing passive orders being above price, they can only be selling limit orders. So those are sellers. And in order for price to get past this area, we will need an equal or higher amount of aggressive buyers, which of course is not for granted at all, right? That's the reason why, let's assume I am long from maybe somewhere here. That's a possible point and a good point as well, where I might want to maybe take some profit, maybe a partial target, because it is a potential point, it is a potential wall for price. Exactly as it was here. Let's look at some previous examples from today. Here price was slowly coming down, and we had this nice block of liquidity. Price crashes through it. Okay, and apparently comes with a nice bounce. It looks like a tiny response from here, but if we just calculate it ticks by ticks, those are 5 points. It's not that much, yeah, right. But it could have been more than a nice scalp, than just a nice scalp. But then, beside that, if I am short somewhere, once I see that and I can detect that price is kind of struggling to keep on selling below this potential support. Why support? Because this liquidity was below price, so it was in the bid side of the book. That means those were buyers, passive buyers. And in such situation, what's the essential condition to keep on going down? Well, selling, heavily selling, even once this level of buyers is beyond, which apparently it didn't really happen, or at least not immediately. So if we were short, that could have been a nice level to take profit, totally or partially. Well, let's spend a couple words on the color of this liquidity. Well, as we said, the color doesn't exactly, or at least this is my personal setting, doesn't really relate in any way with the side of this liquidity, buyers or sellers. The color coding just is an automatic calculation made by the software algorithm calculating the average, the amount of the passive orders being here on this level compared to the average of the visible part of the visible chart. That means, just to make it really easy, if I have an average of 100 and suddenly I have 250, but then still the average is 100, more or less, this line will be represented as a colored band, and the more the standard deviation compared to the average is intense, the hotter the color it will be of the band. That will come with an hotter shading. That means when we have this greenish, low liquidity, yellow, slightly relevant, medium liquidity, orange, medium high, red, high liquidity. And of course, this value can be, and this color coding can be adjusted according to your preferences using this tool right here at the top, where you can just adjust the sensitivity of the calculation. So if you just move the lever on to the left, you're making it less sensitive. So you will have shown more levels with low liquidity. So we have more green prices. If you move it to the right, that will become more selective. So we will only have shown the main blocks of liquidity compared to the calculation the algorithm does. Definitely, if you are looking at Heatmap for longer term analysis, I wouldn't rely too much on something like that. I would rather go for such a representation so you can filter out actually the less important liquidity areas. If you are scalping, then it makes sense to always consider also the minor blocks of liquidity like the green ones. Then What is another reason why what Heatmap is important, and it actually adds some more compared to the ordinary DOM? Those liquidity pools, some of them, you might notice, are quite long, right? They take most of the screen. This one is shorter. This one is quite long as well. Well, this one is huge, as you can see. Compare, that's strong red, and it's very thick as well. But why some of them are just tiny lines here and some others just come from far left? The line starts from the moment expressed on the time axis here below, where this liquidity started to have that kind of volume. Because yes, I can see here, let's assume I don't have an heatmap. Just by looking at an ordinary DOM, yeah, I can clearly see there are 400 selling orders being there and waiting to be filled. But from here, I definitely can't tell how long it has been sitting there and if it has changed over time, unless I am just in front of the monitor every single hour for the entire session, and I just have to watch the level and how it develops. But this is something definitely not that comfortable, neither comfortable nor convenient. An heatmap tells us exactly where this liquidity started to be and to have such amount of volume. And that means it shows the evolutions of all of the most important levels of the order book. For example, let's make a quick analysis of this pool of liquidity. Roughly, it starts to be relevant from here on, but we can see that it wasn't immediately that thick, that relevant, right? It was just green here. Then here there was a gap, then started to be then here came back being green, then it was thickened, even more thickened, even more thickened by here on. From here on, there is a functions in this platform showing also the number of the historical evolution of every single liquidity pool. In fact, let's look at this here. We had 277, then 224, 230 when it was white. Then here, when it got red, this short segment here we had 441, then 300 and something, 350 roughly, and then here started to get above 400, sometimes less, sometimes more, but let's say roughly on average around 50. And then here, look at that, it just changed. because it came with a very strong red. Now price is going away. It is orange. In fact, it's not 400 anymore. That's 350. So we can detect there was a change in here. And as price goes down, we have this huge block of liquidity being provided exactly behind this price going down. Where does this come from? Here it is. That's huge, actually. That's over 625 contracts. What does this mean? That means sellers are strongly defending the down move. Does it mean it is continuing to the downside, is gonna go short? Well, not necessarily, because the market then needs aggressive traders in order to push the market away from there. But at least we have a wall. Look at that. Now there are prices attacking back the previous wall, which it has weakened a lot from where it used to be. Strong red. Price came here and it was a little bit, was still here, but a lot weaker. And then at the moment, here in this area where there used to be lots of massive number of passive orders, we don't have anything left. So that means that looking for a short is still a good idea. Well, I wouldn't say exactly so. In fact, this is something really important we need to talk about. Well, over the next webinars, of course, we will have a look at some patterns where price and these liquidity pools give us some patterns, yeah, of possible behaviors, okay, which will give us some idea of what, for example, this is a very nice one. That means that the push to the downside so far has failed. They were trying to protect price, but apparently they weren't really, that this liquidity wasn't so genuine. They didn't really want to execute that liquidity. That's the reason why the level got weakened even before we traded through it. This is a form, this is just a variation of what is called normally spoofing. Some traders would just place a huge amount of orders to just give the idea of an order book being protected to the downside, but then those orders gets just pulled away before they are executed. This is something very important to talk about, because we always need to remember that all of these passive orders, all of this liquidity, they give us a nice idea of what is going on in terms of passive orders, but as opposed to market orders, as those shown in footprint, those are just intentions. That's it. They would represent very clearly intentions, but they are only intentions. Because why? Because since they are pending orders, they can be pulled away at any time, rather than a market order is an execution. In the moment you spot it on the footprint, that means we had an execution, so it can't be deleted. So in terms of order flow analysis, the best assessment we can do of specific price areas, looking at liquidity pools and other order flow analysis, is always looking at the interaction between market orders and passive orders. It's only in that case that we have both actors being involved, and what we need to assess is just the outcome. So now, so far, we have been talking about liquidity, passive orders. Where are aggressive orders here? Well, those bubbles. Those bubbles are a visual representation of market orders. So exactly the same orders we were analyzing from the footprint, with a couple differences though. The first one is that in footprint we have numbers and mathematical ratios, delta, basically. Here, aggressive orders are more visual. When we have strong green bubbles, big green bubbles, that means that over that price we had a relevant amount of volume being traded. The size of the bubble shows the volume being involved, and the color, that's the dominant delta. So for example, this big green bubble here, that means that here a relevant volume, general volume was involved, and the dominance of that volume was to the buy side in terms of aggressive traders. And what's the other difference compared to the footprint? Well, in this case, we have aggressive orders being represented without an underlying time frame. We have those orders being represented on a naked price line without any time frame being shown. So that means that while in footprint we have an aggregation of volume, and on that basis deltas, imbalances would possibly show, by looking at Heatmap, we don't have any time frame aggregating anything. We just have the bubble showing who was trying to take on to get control of price in that specific spot of the price line, and that's it. Is it more important to look at naked price action with aggressive orders as shown here, or is it better to look at it in an aggregated site like this? Well, I would say they are both important. It can be personal, of course. Some of you might be more familiar with numbers. Some of you might be more familiar with just colors and looking at bubble sizes. Fair enough. The thing is that if we put those two factors in confluence each other, sometimes we have really nice informations. Let's make an example. Looking at here, we can see that yes, somewhere here. Eight o'clock. Well, 10 minutes past 8, roughly. This high corresponds to this high here. And then, as you can see, we had this little fake out. Here, you can really see that buyers were kind of struggling to bring price up, because we can still see some participation here at the top, even though you can see a strong pressure to the downside from aggressive sellers stepping in from here on, from 43.96.75. But here, just looking at bubbles, nice participation up, making a new high, sorry, which way lower volume to the buy side compared to the previous high. They make a new attempt here, 96.75 roughly, exactly the levels we have marked from here in this chart. And then from here on, price starts to push to the downside a little bit. But what I can't see actually from here is what? That before this push, this first push to the downside, look how weak buying bubbles were in this area. They were already weak after making the new high. Price came back within the previous high, and buyers are always buying with smaller bubbles actually, whilst red bubbles always become bigger. Same thing here. Well, that was a quick V reversal. I reckon that would be not that different from here in the chart, but let's have a look at what happens here on this low. Exactly where we are trading right now. Here we can see from footprint we have a nice volume cluster, so we can make the assumption that here there was nice amount of liquidity being provided. We are pulling back the previous low. We can also adjust from here the size of the bubble just to have a clear idea of who is controlling. At the moment, I would say that's neutral. But I would also say that if market fails to make a new low compared to the previous one, then it could be a nice reason to look for a quick reversal, because that would be a failure to the downside. Sometimes, in fact, we can have, look how bubbles to the upside are picking up, and we have basically no more red bubbles. Another important thing, so basically what we will need to focus on the next 3 webinars, it will be the way bubbles actually interact when we get to the most important liquidity pools. Because by looking at those interactions, that's another way to determine the order flow events like absorption and exhaustion. Sometimes we also have additional order flow events like iceberging and stop runs as well. So we are going definitely deeper into the order flow analysis, looking at those informations here. Let's say another important thing though, in terms of liquidity. So we are ready, once said that, to go from next time on through the order flow events and the way they show from here, from the heat map. Liquidity definitely act at first place as possible points of support or resistance, because market will need more aggressive orders to just break those areas. But at the same time, liquidity also act as an attraction point for price. Why? Because aggressive sellers, they need liquidity, especially if they want to execute bigger amounts. So that means especially large traders or professional traders in general, not necessarily institutional traders, but definitely institutional traders, they need to they like to trade within areas where lots of liquidity is provided, because that's the only necessary condition in order to have lots of orders being easily executed. That's still a matter of acceptance. Do you remember when during the first webinars we were talking about balance area intended as area of acceptance as opposed as imbalanced area, considering those areas are as areas with where price traded is not facilitated because there is no agreement from buyers to sellers. Liquidity is the final, liquidity pools are the final indicator where price will tend to be more accepting and where it will be less accepting. Price will also always tend to reach areas where trades are facilitated. So that means that market will always tend to, as a rule of thumb, of course, to go from a pool of liquidity to the next pool of liquidity. Then the way sometimes these liquidity pools form and evolve over time, that will give us some interesting pattern. Because the first pattern we can talk about is that we have two different kind of liquidity. A liquidity which will be more likely to attract price, and a liquidity which will be more likely to reject price at first place. We will be talking about that next week. So we will have the next week webinar totally dedicated to that, how to distinguish between a liquidity which is more likely to attract price and which one is more likely to reject price. They can do both, actually, yeah, but also liquidity which tends to attract price, that doesn't mean that it can then reject price. It will though act somehow like a POC or a high volume node, will tend to attract price first, and then maybe if the interaction shows that aggressive traders are failing, then it will reject price, but after it was traded, as opposed as rejection liquidity, which can reject price even without being traded. That's the main difference, and we will be talking about that in the next webinar. So hope everything was clear from tonight. I know that's a new topic, that's something that maybe you're looking at observing for the first time. So if you have any question, please feel free to ask me. For example, here we have a nice block, and we can clearly tell that this is not that relevant as this one, as this was, and so on, going backwards. Look how they're trying to reinforce this level. And let's assume that price actually bounces from here, even without trading this liquidity, where we'll be most likely to get up to, well, 1 and 2. Just to introduce quickly what we will be talking about next week. So I guess there are questions. So yeah, thank you again for your participation and your interest. Oh, there is a question.
Yes, there is, I think, question. Yeah.
I just assumed too early there were
Yes,
questions.
yes, yes. Let's give them some time in order people do have the time to ask the questions.
Right. So the three profiles at the right hand of the screen are volume profiles or which time? Good question. Basically, those. Well, let's start from the two profiles at the very right hand side. Those are at the very right hand side. That's a delta daily profile, and the one here at the middle, that's a daily volume profile. Um, you can't really see numbers because, yeah, I should be able to zoom it, but yeah, those are daily. And these, if you're wondering what those are for, those aren't really a volume profile. Those are, that's a representation uh, according to the volume histogram scheme of the liquidity is changing over the last auction. So this is something definitely that's not a volume profile, but it's just telling me the immediate change of the limit orders, which is something that it it is also available from here on. From here in the heatmap, we can see, of course, if a block of liquidity is showing, that means that there will be high amounts of volume being stacked to the liquidity already being in the order book. So this is something more specific in terms of DOM reading. But yeah, profiles being available here are daily delta profile and daily volume profile. If you want, you have the chance to also have a resetable profile and decide if you want to set it as a delta profile or volume profile or delta and total volume, or else bid versus ask volume. This profile is particularly nice because it is something, that's the one showing here, RDP, resettable delta profile. With this tool, you can just reset it when you want. So it will just show you either volume or delta from the moment you have reset it from that moment on. If you want to maybe just have a look of specific price range, the way delta was interacting over throughout that small range, which this is something which actually I find very, very useful for scalping, for example. Another question, is the software provided with the challenges and with all markets? Well, in terms of challenges, To be honest, I don't know about that because this is something that you should be better asking maybe to the trading page support. By delta, I mean the if you were referring to the delta profile, the horizontal delta traded at that price. So if, for instance, just to make an example, here at this level I had 100 aggressive buyers hitting the ask and horizontally 500 hitting the bid, that will show a plus, that will be a representation of plus 500, and the length of the histogram will just indicate how strong that delta is, as well as the shading of the color. The color being green or red, exactly as well as the footprint, will indicate the dominance, which delta, which side of the delta is dominant, either buy or sell. Another question, which is the name of the indicator, or in the orders, in its liquidity looks like a volume profile. Yeah, I think you were referring to that. That this is the one I was talking about earlier, showing you the immediate change of the liquidity. That's an option which is called stacking or pooling, which is available here. If you just press this button at the very right hand side of the screen, you have got all of the options available for the DOM section of the platform. It should be somewhere here. Yeah, settings, DOM. And that's the pool stack column. You can here decide whether you want to have it shown as a profile, which is actually the style I decided to go for. You can decide the color of orders being stacked and orders being pooled. Of course, the main representation we will have is that when you have an area where orders are being stacked compared to the ones already being there, you have a positive number, plus 148. That means that before this last change, here there were 229 229 passive sellers being here. After this change, they have been stacking 149 orders to those 229 orders, and we have now 378 orders, as opposed to situation where they are pulling away liquidity and that will result in negative numbers, like here -8. That means that before this last change, here there were, for example, only 59. Oh, it has just changed. Anyway, that's let's freeze it so it doesn't change whilst I'm explaining. Here we had that's easier. 109 with a negative variation, last variation of -4. That means that seconds ago we had 113 here. The last variation was -4 lots, which were a apparently pulled, and now we have 109 remaining contracts. So the name is pooling stacking orders. All right. Okay, guys. So I think that's it. That's it for tonight. Thanks again for your participation and your interest, and have a nice evening, and see you next Wednesday. Have a good night.
Have a good
Cheers.
night, everybody. Thank you, Eduardo. Have a good
Thank
night.
you, Alex. Bye bye.
Bye. Bye.